Today we're going to take a look at how to account for the issuance of stock. So you give out stock and then we account for that. We put that in the worksheet. So let's take a look. Okay, so here we have the stock worksheet, and we're keeping track of any stock that goes out and any increases in our cash or equipment. So for example, let's say that we give out $125,000 in preferred stock. So people pay for that. That increases the cash in the bank, but we'll come back to that. At the same time, we also give out, for the first time, we issue $500,000 in common stock. Now those two together are going to increase my cash for $625,000. So I have a debit, an increase in cash in bank, and I have a credit, but also an increase in preferred stock and common stock. And they cancel each other out. Okay, so in my normal journal, I'm going to come over here and I'm going to create a new line for August 1st. That's when this happened. And I'm going to put cash in bank. That's the debit. Debit goes first. And we're going to put $625,000. Okay, next line is going to be credit. We're going to give some space. We're going to indent this. 1, 2, 3, 4 spaces. And then we're going to write out what happened with credit. So we gave out preferred stock. That was worth 125. We also gave out some common stock. That was worth 500. Okay, and then we also have one more line that we indent even more. I'm going to do 8 spaces. 1, 2, 3, 4, 5, 6, 7, 8. And this is where we put, you know, where did this transaction come from? If we had to look it up, if somebody did an audit, where did this come from? What's the proof that this happened? And that would be receipt number 1 in this case. Okay, so we hit enter and we are good to go. That is our first transaction. Stock was issued, we kept account. Okay, let's also say that a business instead gives us equipment and we give them stock in exchange. So they're getting value and we're getting value. It's going to cancel out. So let's go look at the office equipment. Let's say they give us $6,000 in office equipment. Okay, they also give us a building that's worth $60,000. So we're going to go to building, and that's an asset that we are adding. And then they also gave us some land that was worth $30,000. So we're going to put $30,000 in the debit column for land. Now altogether that was $96,000. So that is also going to go out, and we're going to give them some common stock. So $96,000 in common stock was given, and we got $96,000 in value of equipment and things. Okay, so now we got to put that in the journal. So this happened on August 2nd, we'll say. And then we have building. Okay, building was debited for $60,000. Remember, debits always goes first. We also had land, and that was worth $30,000. And we had office equipment, and that was worth $6,000. Okay, now for the credit part. So we have 1, 2, 3, 4 space, and this was given out as common stock. And that would be for $96,000. So we're going to put $96,000. And then right below that, we got to keep track again of where this came from. So if somebody had to look it up. So 1, 2, 3, 4, 1, 2, 3, 4. And then we're going to put, this was a memorandum, which meant a note sent to us that this exchange happened. We'll say memorandum number 10. Okay, in real life, of course, we would know the memorandum number, and we would put that there. Okay, let's say that on our third example that we issue stock, but people pay more than its par value. So let's say that our stock up here is worth $50, but we sell it for $60. So we're going to sell 1,000 stocks at $60. Okay, now the par value is only $50. So although we're getting $60,000 in cash, so here I'm going to put $60,000 of cash in the cash in bank, I'm actually only issuing $50,000 in common stock because equals there's 1,000 stocks times its value is only 50. So I'm only issuing 50,000, but this isn't balanced. So I need another 10,000 to go somewhere. So there's an account called paid in capital in excess of par. So that's capital that we now have that was paid beyond what was supposed to be paid. And so that's another 10,000. So if you want to do the math here, we got 60,000 minus the 50,000, and that would equal 10,000. Another way to do this is to press equal, and we got the 60 minus the 50. All right, so that's 10,000. Okay, so there we go, $10,000 extra. Now we got to go record this. So we got August 3rd. Okay, and we are going to be, I don't know why that did that differently. Oh well. Okay, so on August 3rd, we are going to get some cash in bank. That's the debit. All right, and so that was 60,000. All right. But then down here, we sold some stock. So we're going to put common stock. But technically, we only issued 50,000 in common stock because that's what it was worth. So the second one that has a credit is paid in capital in excess of par. That's what it's called. I know it's long. So that's another 10,000. So these equal 60 plus the 60, and we would then of course have some kind of note here or receipt. So we're going to put receipt. We'll say it's number 5. All right, and that is now accounting for the excess. Okay, so let's say in this last situation that someone subscribes to buy stock, but they haven't yet. So they promised to buy it, but they haven't paid for it yet. How do we deal with that in accounting? So let's say that on August 4th, we are going to receive a subscription. And so they're promising to pay it, but they haven't yet. So we've got a couple things. First of all, they have promised to us. So that's a receivable. It's money owed to us. So let's say they buy 100,000, or they're promised to buy $100,000 in stock, but they haven't yet. So we have to have something to balance that yet. We don't have the cash yet, and we certainly haven't given them the stock yet. So we have another account called common stock subscribed, and we're going to add 100,000 to the credit side, the plus side, and now they're balanced. So it's owed, but it hasn't been paid. Sorry about that. Okay, so let's say now that, we got to record it. So let's say here we've got subscriptions receivable for common stock, okay, and that was debited 100,000. And then for the credit, we've got common stock that has been subscribed but not given, another 100,000 here. Everything's balanced, and that would be a memorandum or a receipt. We'll go with memorandum, let's say number 12. Awesome. So it's been promised. Now let's say that they start paying on that subscription so that they can pay it off and get the whole stock. So what would that look like? So first thing that would happen, let's say they pay 50,000 of it right now. So the first thing that would happen is that cash would go up in the bank because they paid us. Okay? And we're going to take that off their bill, right? So the receivables, the money that's owed, is going to go down 50,000. All right, so that 100,000 is going to go down 50,000. So now we have a new balance, and this is, let's say this happens on August 5th. So on August 5th, we have a new balance, and whoops, I'm going to copy that over here. And now we just have 50,000 left in receivables. Okay, so here I put the balance that's to say we're starting a new line. Okay, so over here let's record that. So on August 5th, we had a cash in bank go up. That was debited to us, so we got 50,000. Okay, and then we also took down the subscriptions receivable. That came down 50,000. and that would be a receipt. So we have a receipt that happened. Let's say number 25. And so now we've taken some cash. They owe us less. They still don't get the stock because they haven't paid the full amount. So one more time, we wait for a payment. Let's say on August 6th, they make another payment. Okay, so let's say some more cash in bank. Oops. I'm just going to copy this real quick. Control C, Control V, and then this is going to be another 50,000. Let's say. Okay, and then this would be receipt number, let's say 26. Okay, so now of course we got to take care of that over here. We got another 50,000, and they owe us $50,000 less than they did before. So another $50,000 is going to be credited. So then we've got a new balance on August 6th of 0. Okay, everything's been zeroed out because there's nothing owed anymore. All right, and now we still have though the common stock subscribed. All right, but nothing's owed anymore. And so what do? Well, now we have to finish this and make sure that this common stock subscribed turns into real common stock. So what we're going to do is we are going to change this credit here of the common stock subscribed to 0. So we got the common stock subscribed, and that's going to be 100,000 to debit, and all that does is get rid of this. So if we put the 100,000 here, then we have a balance of 0 now. So August 6th, the balance 0. Oops. Awesome. Okay, but now we got to give the stock. So in the credit section, we're going to issue common stock of 100,000. So here this 70,000 should not be here. Sorry about that. So we have $100,000 in common stock that has been issued. And that's it. So we put the receipt here, or the memorandum that was issued. We'll say 125. Okay, and then that's it. So that's pretty much how you handle subscriptions. And that's it for this video. We are going to do another one where you guys get a chance to answer and participate. If you have any questions, though, let me know, and let's move on.